We should all be very familiar with shifting narratives across Bitcoin, the stock market, and real estate. And today's video is no different. We're covering the shifting narrative that has now gone from the bears flipping into the bulls. This current narrative is based on the golden cross, but I also want to show you where the insiders or the smart money is selling and where is a good possibility to be entering the market again. If you haven't already, smash up that like button, subscribe to the channel, bell notification icon, and if you haven't already, check out the link in the top of the video description. Our free crypto and economic report will be emailed to you once every 2 weeks. No spam, only deep alpha. All right, guys, let's start with the headlining topic at the moment. And we know that this tends to shift so often. So let's cover it and see what it actually means for the market before we get on to the selling that is happening in the market and where the next buying opportunities are. So this is the golden cross. We have the 50-day MA, the moving average, moving above the 200-day moving average. Essentially, this is seen as a bullish move, but of course the moves already happened from November, like we've been talking about here on the channel, where we've seen multiple indicators signaling that this is probably the bottom for Bitcoin. I'm not going to say it's 100% the bottom, but it's likely that this is the bottom. Just like we talked about in June as well, in mid-June, where we thought this could likely be the bottom. But if the market did go lower, it's not going to go that much lower. So the November low that came in was perfect for the timing of the cycle, being about a year down from the top. So that gave us the timing aspect. And then in terms of price, the price was not that different to June. So buying anything under 19K, like we looked at with our Bitcoin cycle buy zones, has obviously been a pretty good purchase. We're not out of it just yet. We're a few grand above, so maybe we do come back down to that 20. We'll wait and see. But essentially anything from June, buying as much as you can according to your own trading plans has been a pretty good option. And so now we start to see the moving averages catch up with what we've already thought for the last 7 or so months. And so this is the moving average going above. Now we also have the death cross happening on the weekly moving averages. So basically the 50 dropping below the 200 on the weekly chart here. But let's just make it nice and simple, and we'll just stick with the daily moving averages. Now, this isn't something that I would be using for my trading, but just looking at some signals for a more macro play is what I like to look at when it comes to the moving average. As you guys may know, all my trading is based off the Gann swing indicator, as this gives us signals closer to the market and more confirmation than what a moving average does, because this is based on over 100 years of data across all markets. Anything with a chart, this tool covers. So let's take that off for now and essentially just have a look back at what has happened with the moving average. And so I want to go back to the previous cycle and just look at the golden crosses that have happened in the market here. We had the first one here as the market already started to pump out of that low. So kind of similar to what's happened now. And at the exact time, so depending on the time frame that you're looking at, some people are always worried about the very short term, the days. If this video goes out and the market drops, they say, well, it's dropped from that point. And you go, well, look at the next 2 months. It was up from that point. So it's really going to depend on your time frame. And you can see the golden cross happened around mid to late April. There was a day or two down, and then the market took off from that point. So there's your golden cross. And that's basically the first one within that cycle. There was a death cross. So the bear market trend had the death cross. That was the 50 going under the 200. So when the red line is above, there's your death. And when the yellow line is above, there is your golden cross. I made the colors nice and easy to use here. And so we had that golden cross. We already knew that the run had begun. And then we had the death cross. Market pumped from that point and then came back down. Then we had another short-term golden cross, market drops, and then the death cross again. Finally, golden cross, and then of course the rest is history from that point. We went all the way up and finally had that next death cross, golden cross, and of course death cross. And so the thing I've looked at before on the channel is how many times has this come up? So this is the transitional period. That's what I want to look at here for BTC. So we had one golden cross, we had two golden crosses, and we had three golden crosses. That's all within the bear market or transitional period going from that bear to the bull, which some would call the accumulation. And I want to get onto that and look at where these investors are selling and then where the next levels are for buying based on the selling that is coming in. We take a look back to the prior cycle again. So this is through the bear market and the accumulation phase. Just looking at the daily moving averages, we had the death cross here. There is a golden, then a death. So we'll call this 1, then we'll call it 2, because that's another golden cross. And then our third golden cross, obviously the market's already pumping by this stage, but we had 3 golden crosses again. And basically from that point, that's the last of the major bear markets. We did have another couple of short-term bear markets, but we only really got one golden cross. This was back in around 2012, so early 2012. Then the market took off from that point. So this isn't really enough data to say that we're going to have 3 golden crosses before the market takes off. But what I like to take from this is that it shows the inconsistency of the trend, which essentially confirms the transitional period of a market. And transition meaning we have the bulls in control, then we have the bears in control, then the bulls, then the bears, then the bulls. And it's basically a time for the market to be making up what it wants to do next, making up its mind where it wants to go next. And if we continue to remain with the market, so continue to follow up on your own analysis, check your charts, stay with the market, continue to invest however you see fit, you'll begin to get a feel for how this market is moving, and you'll see the ebbs and flows of the market and start to see where the lows are coming in, getting those more macro higher lows, which start to give you that signal that probably the bulls are beginning to regain macro control compared to the bears, like the bears had just done in the previous section of the market. So I don't see this happening for the market running off to new all-time highs from this point, but at least it gives us a signal that we are probably beginning to get into that transitional period, and it's a good time to stay with the market. It could take 1 year, it could take 18 months before we actually find our way out of it and confirm that the bull is on, where we start to break a whole lot of tops and we just don't see those prices again. The amount of time that it took to go from the cycle bottom to that final golden cross before the market broke out in the previous cycle was 523 days, so a year and a half or thereabouts. So that was the 3 golden crosses, and the market took off from that point. So it was still a pretty long transitional period. If we go back to the previous cycle, this one was of the bear market 2014 and the accumulation market of 2015, the day count from the cycle low using the January low here to that final, like you can see here, the final golden cross was 286 days. So roughly about half the time what the second cycle took. Now, I'm not going to say that the current cycle, being that where the third cycle is then going to double the previous cycle of 500 or so days, and we're going to be down in these ranges for 1,000 days. I don't think that is likely. I think it's going to be something more within those 2 particular ranges, maybe the 200 days, maybe the 500 days. Nonetheless, we'll be able to see those signals before it happens. But either way, the point of this is the transitional period can take quite some time, a year, year and a half, like we've looked at before. But within that transitional period, we know that the ranges can be quite significant. In the case of 2015, approximately 100%, going from that $150, $160 bottom to those tops at around $300. We know the next cycle in 2019, 2020 was approximately 350%, going from the lows of 3,000 to those peaks of 14,000. And so there is a lot of trading opportunity. There are going to be many, many tops, intermediate tops, before you see some plunges. So it's going to come down to who you're potentially following, or the analysis, even better, your own analysis that you're doing, to say whether these are significant tops in your view and whether you're going to be buying any of these sort of bottoms, or you're waiting for a breakout of these tops. There are going to be a lot of tops. So I'm going to make that really, really clear because we're going to hear that a lot and people are going to be quite confused thinking that this is the top and then we're going to go back to lower prices than previously. But once you've gone on quite a significant run, it's probably unlikely, not impossible, but probably unlikely that you're going to see some more severe downside past the previous cycle low. So if we start to head up further from this point here at $22,000 or $23,000 and we break 25 and start to test 30, it's getting less likely that you're going to see a test of 15K or 16K, or for some of those unfortunate bears, a breakdown of 15K down to 14, 12, 10, 8K, 9K in the case of some analysts out there. So the further this thing goes on, the more unlikely it is that we're going to break down, especially if we go on and then hold support at higher levels, which brings me to where the investors or the smart money is selling and where those next support zones are good opportunities for buying. And we're looking specifically here at the Wyckoff accumulation. Now, before I jump into that, just a reminder to like, subscribe, because this is the stuff that I go through every day on the channel here, looking at the market sentiment, looking at the Wyckoff accumulation, looking at Gann analysis, in particular, our swing strategies that we use. And if you want to stay up to date for free, check out our crypto and economic report. Link is in the top of that video description. It's absolutely free and it's emailed to you once every 2 weeks. This is where you go here, drop your name and email and click that subscribe button. So the next thing we are looking at is this accumulation phase of Wyckoff. And if we're to believe that this is where we're at, the accumulation, then it's potentially phase D that we're now entering. So what does phase D actually mean for the market? Well, let's scroll down, have a look. Essentially, phase D is where the evidence of the pattern, so this is the strength, signs of strength start to show up, as well as the reactions. So basically where the market tops out, which is what we're talking about today, where the possibility of some selling comes into the market because the smart money, or at least the people who are manipulating the market, need to figure out whether there is any more supply available in the market. So we have to start selling to come down and test those lower prices, basically where we currently sit. Maybe we don't head up to new highs from this point, but either way, even these smaller ranges that Bitcoin is experiencing from 24K down to these lows here at 22.5K, this is all a test of where is supply and demand coming in. So is there more supply coming into the market to drop the market down to then go and test the demand? The demand is essentially the buyers. Are the buyers coming in and stepping in at higher and higher prices? If so, let's mark that price back up, test where the supply comes in, test where those sellers are coming in to dump their Bitcoin again and start to head down. And so this is the dance that's going to go on for what I think several months, probably looking at, like we've seen in the past, sort of 12 months, 18 months. And the dance can be on shorter term timeframes or longer term timeframes. You have the shorter term stuff that is going on in those narrow ranges, like we've seen through November and December, and it also happens on the longer term timeframes and those bigger moves in terms of, say, the weekly chart or the monthly chart, like we've seen in the past. And this is the dance going up to the high. Big supply came in at $13,900, and that slowly began to dump the market. So the dance begins again, and we get the weakness, the dump, and the dump, and that final dump. So that's what we're looking for at this point in time. So where is a good place to buy? What does the rest of this mean to the market, looking at particularly phase D? Well, the last point supply, so LPSs, in this phase are generally excellent places to initiate or add to profitable long positions. So even if we haven't got into the market yet and we've waited this entire time, any of these last points of supply are great places to start entering the market based on the Wyckoff method here. Now, remember, we are trading this market. People call it investing. It is trading. If you're looking to make a profit and sell the Bitcoin and then go and take fiat currency or whatever else, gold, silver, I don't know, then that's trading. Even if it's 1 year, 3 years, 5 years, 10 years, it's still trading the markets. Maybe you plan to hold it for 20 years or forever, then you can call it investing. But the majority of people are trading. They call it investing, but essentially they are trading. So that's why we're going to call it traders here and look for those points of supply or at least those last points of supply, basically where the market starts to dry up because it's the last point. There's no more supply coming into the market, which forms a higher low, and the market moves from that point. Now, if the supply does come in, then traders, smart money, will have some stops in play. They will look to lower levels, and after they've bought up this level, they don't see the rise that they were expecting and the market goes against them. They will have levels to sell out again as the market breaks down. That is called a stop loss. And this is something that needs to be implemented in everyone's trading strategy, their investment plans, whatever it may be, so that if they are wrong and this isn't the last point of supply and the last point of supply is lower, then you have a trade that you now have a limited risk on. So back to the accumulation phases here, we're looking at the last point of supplies, the LPS, the BU, which is the backup, and more of the LPSs. And so we're looking at this as potentially being the phase D, and this is the sign of strength, these peaks. Like we can see from the chart here, this is potentially the sign of strength. Like I've said, none of this is 100% confirmed until the market is out of this zone and breaks those tops and confirms that this was the trend. It's the same deal all the way down. You can start to label up any of your Wyckoff schematics on the way down, but if the market breaks down, hopefully we get out and we just start to form the next accumulation or distribution schematic on the way down. That's why it's still important to have some stops in play, which is why I talked so much about it before. Because at the end of the day, no one knows 100%, and all we're doing is weighing up the probabilities and entering the market as best as we know how. So, last point of supply, the levels that I'm looking at here on the chart are around that 21,000, maybe it's slightly lower here at 20,500. That level I've looked at many times before, around that 20,700. So call it a nice easy round number. Between 20 and 21,000, I think is going to be a pretty good level of further accumulation. We have to wait and see whether this is going to go lower or if this is the point where the demand comes in and we start to head up again, because we just don't know from this point. And we want to see what those sellers are going to continue to do. What we do know is that the sellers have been in control for the last 1, 2, 3, 4, 5 days until today. Now, the BLX chart doesn't show the current day, but we can see that on any other chart here, where these last couple of days or last day was up green, and currently we're just sitting at a new open as well. But this is one that I've got all of the data on here for the Wyckoff schematic. So really, the sellers have been in control for about 5 days, which is longer than anything we've seen in this whole move to the upside. So although we do see some bounces, it's going to be critical to see whether the buyers can step back in and break above 23,900, 23,800, or around that where we're looking around 23,000 again. That's where all of these tops are coming in, which is why we're looking at it as being a critical level for the buyers to regain to move higher. Of course, if we're trying to enter at the lowest price possible, we want to see the buyers fail, the bears step back in and continue to sell off into this market like they have done for the last 5 days, longer than any period since this mega run started in late December and early January. So it's basically been the strongest period in terms of time for these sellers. So during these phases, if in fact this is coming towards the end of this first accumulation phase, and maybe that 12 months started back from June, I don't want to get too greedy here and expect that we're going to go back and test 17, 16, or even 15K. I want to ladder back in on the way down. If we do break further, that's going to be good. We can get cheaper prices, but if we don't, I don't want to be greedy and wait to see this market head higher just to not be able to get that cheaper Bitcoin. But the upside to that is the confirmation would begin. If we break above 25K and find support above it, then at least we have more confirmation that the bulls are in control, the more macro bulls are in control. So it's a game of probabilities. Where does your risk appetite lie? Let me know in the comments section down below. You're looking for that opportunity further down, that greed for the lowest price possible? Or are you starting to come to the realization that maybe this is part of phase D in the Wyckoff accumulation, and potentially over the coming weeks or months, which I think is probably more likely over the coming months, we start to head into this phase E where we break out of the trading ranges and work our way higher. Let me know in the comments section down below. While you click the like button, subscribe to the channel and the free economic and crypto report down there as well. And a quick shout out, the shill at the end of the video, to our channel sponsors, Bybit, BitGet, and SwiftX. That's your trading platforms over there with thousands of dollars of sign-up bonuses. Stay safe out there, guys. I'll see you at the next video with more macro cycle analysis. Don't go anywhere. More videos are popping up on your left-hand side. Until then, peace out.